Cloud. Awesome. Well, a warm welcome to everyone here, and I'll just keep emitting people as we
Sure.
go.
Hello, everyone. Thanks for joining.
All right. So my name's Brent. It's good to be here. I'm acting as your host today. I met Dale a few years ago, and I've appreciated his perspective and support. And I'm here to support Dale, and will help manage the Zoom side of things and help guide the call. So, Dale, you want to tell us a little bit about yourself?
Sure
Introduce
thing.
yourself.
Start with a brief introduction for some of you know me and some don't. But thanks for joining us. I'm absolutely super excited to be able to chat with you today, and hope to do more of these in the future. And thanks so much to Brent for putting this together. Should be a lot of fun, and hope you get a lot out of it. A quick introduction to myself. I'm actually originally was a long time advertising guy. I like to say still recovering advertising guy, whereas a writer and creative director in the ad industry, had a wonderful, reasonably successful career there. And during that, again, became kind of an original ETFer, if you will, a long-time self-directed investor. Semi-retired because of that, did some successful investing, semi-retired many times along the way. As I like to say, my greatest financial skill is cutting my income in half, and then cutting it in half again, and then doing that again. From there, I was writing on Seeking Alpha, writing articles on ETFs, all kinds of portfolio construction, and then made a career shift to Tangerine, where I was an advisor and became a trainer, because I'm such a nut for this stuff. So I was there for about 6 years, and then left the job I loved every minute of it. It was an amazing opportunity to talk to Canadians and see how they invest, and just get a grip on everything from how they invest, how they think, behavioral. It was absolutely incredible. But left that to start Cut the Crap investing in 2018, and write for Money Sense as well. So did a bit of a journalism career, if you will. And it's been an incredible opportunity to, again, from once you do your own blog, then I can talk about building simple ETF portfolios, stocks, more. It's just a wider, broader path, if you will, for being able to do that. And yeah, that's a quick me, and I'll send it back to Brent. He's going to tell you about more of sort of the call flow and how this will play out today.
Exactly. Yeah. Well, again, welcome everyone here. So the goal of the call is to help you evaluate your current portfolio and chart a path forward over the next 12 to 18 months and beyond. We sent out a presentation before this to give you a preview of what Dale will be sharing, and just get your mind thinking about it, right, and prepare you for this. So we're going to start off after we do some introductions. We're going to do a couple polls, see who's on the call and where you're at. Then Dale will represent that information, take about 6 to 10 minutes, and then we're going to just open up for reactions. So we'll be using the chat feature in Zoom. If you're not familiar with it, it's along the bottom there, and we'll test that out in a minute, get everyone to introduce themselves. And then after we kind of open up for some reactions, we'll just have some Q&A. So we'll use the chat for that, and I can feed those questions to Dale. Or if you want to raise your hand, there's a raise your hand feature under reactions in the bottom right. You should be able to see a reactions with a smile and a plus. And there, if you click on it, there's a raise your hand, and then it'll show a hand in the corner. And then we'll field as many as we can in this time. If we don't have time to get to all the questions today, Dale will be responding through his newsletter, through Twitter, and the other channels, or maybe future calls as well. So. And I'm just going to keep admitting people as they come in here. So awesome participation today. It's great to see so much interest in the topic. So before we go any further, I'll just say when it comes to getting the most out of this call, like we'll just ask everyone to stay muted unless you don't have any background noise, and you're fine to stay unmuted. That some people have dogs and kids and whatnot going on. So again, we'll use the raise the hand feature, and we'll just ask everyone to just be as present as possible. I know there's lots of distractions. You're here for a reason, so invite you just to turn off your cell phone if you're on your computer, and try to just be as present as you can and get the most value out of the next 50 or so minutes together. Yeah, so let's just use the chat feature here. To just get to know everyone a little bit. So if you on the bottom you just click chat, it'll open it up, and just ask everyone here. Just put in the city, either province or state or where you're located. Yeah. So just give us a sense where you are. Vancouver and London. Awesome. Yeah. Just seems like everyone's pretty familiar with Zoom these days with I think the COVID
Meet on
pandemic.
Zoom.
Yeah, the Zoom friendly. All right. Sudbury, Windsor, Victoria, Edmonton, Strathroy. That's where I was born. Toronto.
LA, Pennsylvania, awesome. US.
Cool. Great. If anyone needs any help, technically, feel free to just put it in the chat there if something's not working for you. I'll do my best to respond as we go along here. So I'm just going to launch. We're going to do 2 quick polls. So I'll launch the first one here. It's about stage of investing. So want to understand where you're at. Again, this will help Dale kind of pivot or customize his responses and also think about upcoming opportunities as well. So I'll launch this. So you should be able to just select one of those. So you have 2 options there: accumulation phase or retirement decumulation phase. So I'll just keep it open give it another 30 seconds or so here. We're up to almost everyone has participated. Of course, everything today is optional, right? You don't have to participate in anything. We're all adults here, so we got 86% participated. So I'm just going to end the poll here, and 5, 4, 3, 2, 1. Looks like that's what we got for now. So let me just show you that. Share the results with you here. Do you see that?
Yeah, nice mix there.
50-50.
Half and half.
Yeah.
Cool.
Okay, and so it gives us a sense of where we're at. And then here, let me get the next poll. So the next poll here is how confident are you today that the portfolio, that your current portfolio, it looks like I have a typo in there, has the right mix to achieve your goals. So we've got 4 options, and don't choose the one at the bottom. I see there's a little typo there. So one of the 4 options, here, I'll launch it here. You can see this. So how confident are you today that your portfolio has the right mix to achieve your goals? I'm going to end the poll here. It looks like the same percent of people, 46 of you are responding. So let me share those results.
Nice.
What's your observation there? Looks like a fairly confident group here.
Yeah, we've got a pretty good. And once again, there's always going to be the folks that wanting more and not very confident. That's natural for. It's tough to be very confident. It's good to see a few though in that range.
Right. Yeah.
Nice.
Awesome. Thanks everyone for doing that. Gives you a sense also who's on the line with you and is participating in this community. So I'm going to end the polls here. And Dale, I'm going to hand it back over to you. So Dale's going to walk through the presentation, give us a foundation of his perspective, and then we're going to open up for some reactions to that. So.
Okay, so give me a second. I'm just going to turn this into. Sorry, one sec. The wrong thing there.
Can you email me?
Put in slideshow. There we go. So this was a quick video that I had. Let me just get rid of this box here. And it is on a YouTube hide floating meeting controls. There we go.
Fine.
So there's a presentation in video form that, again, I'll send this stuff to you later. Actually, it will be on my site, and I'll put some other blogs and such that can add some support along the way. So this will be on building the perfect portfolio. So in this presentation, again, I'll take you through a simple but very, very effective way to build an investment portfolio. And again, building wealth, the interesting thing here is that building wealth it really should be one of the most rewarding and stress-free things that we do in life. First, though, you'll need to get your financial house in order, right? And what that means is clear bad debt. Obviously, there's a lot more to this, but the basics are clear your bad debt, spend a lot less than you make, right? You now have money to invest on a regular schedule. Obviously, we're not going to make any money, no matter how great our investments are, if we don't have money to invest, right? So it's very important to have that free cash flow. It's a very, very important step. And here is, so how much money, let's say if we do free up and we can invest, here's a very simple example. So let's just simply max out our tax-free contribution, which of course is $600, $6,000 per year, $500 per month. So here's an example, just using stocks over a 25-year period, just invested, we leave it alone, we don't touch it. That amount could grow to over $800,000 over a 25-year period. Again, that is just absolutely incredible. Again, as we always say, past performance doesn't guarantee future returns. There's no guarantee of this, but that is the history of stocks over time. So what we can do, again, the biggest money makers, of course, in history are stocks and real estate, right? Most of the rich people that we know, they're either in real estate or they're buying stocks or a combination of both, right? So again, we can buy the stocks or we'll buy the stock markets, which is what ETFs allow us to do. We can buy real estate, and those are called REITs, as you may have seen, right, or know, right? Whether it be in funds and mutual funds or exchange traded funds. So we can add those in. In this portfolio example, we're mostly going to do just buying the stock markets. And of course, we can build wealth by way of home ownership. I would say for me and our wealth building for my wife and I, it really has been real estate in our home. We're lucky to live in Toronto, where obviously real estate is just bananas, that is in major cities, and add in our stock exposure. And that's been a really, really nice 1-2 combination. But once again, it came to that number one of, we're not big spenders. It was clearing our debt, having a lot of free cash flow for paying down our mortgage and continually investing in our stocks. Once again, so how much do they make? Historically, stocks and REITs, they can make about 8 to 10% per year. Once again, no guarantee of future returns, but that is the history. But of course, when we talk about averages, no such thing as average, of course, right? That we know when you're investing in stocks, REITs, housing, whatever it may be. The returns can be all over the place. This chart here, even in table form, doesn't really do justice, but we know stock markets go up, they can go down. We can have corrections of 10, 20, 30, 40, 50%. And it can take a while to recover, of course, from that, right? So there is no average, if you will. But again, once we get into periods of 10 years, 15 years, 20 years, 25 years, the odds of success and great success are absolutely incredible, right? So what is a stock? When you own a stock, of course, think of it as company ownership. You own a piece of that company, you own a percentage of the profits. And when your company does well, you do well. As we know, the richest folks on earth, well, they own companies, they own businesses like this guy that we know, right? We just bought another one in Twitter just over the last few days, apparently. So you can join them and you want to join them. Again, this is the path to wealth is by company ownership, right? And in a portfolio, of course, we're going to own many companies. Here's an example again. There's the Musk company of Tesla, Apple, and Nike. I own these all myself. And again, we're not going to own just hundreds. We're going to own thousands, if not even tens of thousands, if we want to buy the developed stock markets of the world, right? And in the name of diversification, Canadians and all investors are really guilty of having a home bias, meaning that we invest way too much in our own country. But in the name of diversification, we're going to invest in Canadian, US, international stocks, and stocks in Asia as well, Europe and Asia. So we really want to cover the globe, if you will. And again, ETFs make that available where we can essentially, buy the developed stock markets of the world by just pressing one button, entering one ticker symbol. Now, the thing, of course, with stocks is we want to lower the fear factor, right? They can be volatile, as we're finding out this year. And it can be a crazy ride, right? It can be a scary roller coaster ride. So to lower the volatility, very simple, we're going to add bonds to the portfolio. An analogy that I like to work, and I would use this at Tangerine as well with clients, is that bonds work like shock absorbers. And if we put enough shock absorbers in the portfolio, we can turn that scary roller coaster ride into a kiddie coaster ride. Again, it's absolutely crucial that you understand your risk tolerance level and stay within your risk tolerance level, right? The only good investment plan is the one that you can actually stick with. So here's a nice table that shows sort of the drawdown or maximum loss, if you will, of a portfolio. So on the left-hand column there, we have a 100% to zero. So that's a 100% all stock portfolio. We see that maximum loss historically, this would go back to, let's say, the great financial crisis of 2008, 2009, and even the dot-com crash, if many of you were around for that like I was, which was just terrible, where stocks again fell by 50%. We can see if we go to the 60-40, that's a classic balanced portfolio. Now we have a portfolio that only declined by about 25%. And if we go to the other range, we see the 30% stock portfolio to 70% bonds, only down by 10%. And the 20% stocks only down by 5%. Right? Again, no guarantee that it's always going to work out like this, was a general framework. And the key really is to match your investment portfolio to that decline column, right? Like how much of a decline can you actually take and stay invested? Again, the simple portfolio, here we go, it's the building blocks of Canadian stocks, US stocks, international stocks, and Canadian bonds. Yes, we'll talk about later, we can add other assets and other bond markets, if you will, but that's typically the core that we'll use in Canada, right? Is use those Canadian bonds. And once you have your asset mix figured out, again, we go back to that TFSA example, you really want to put your investments on autopilot, right? Just move in monies every 2 weeks, month, every payday, what that is, invest, whether it be $100, $200, $300, $500, $1,000, and bring that up over time, right? As our careers move on, we start to make more money. You want to adjust that, of course, invest more as we go. But really, you want to set it and forget it or wind it up and let it go. Again, those are phrases that we would use with clients at Tangerine, where, again, not every place allows you to do this. Sometimes you have to move monies in manually, but at Tangerine, they could set it up where it's happening automatically. And if you can, just do it. Just set it up and set it and forget it. Let it go. So building the actual portfolio. Now, here's the wonderful thing that, well, again, we're going to talk about building your own ETF portfolio. There are game changers in Canada, of course, and anybody who reads my site will know about this. They're the all-in-one asset allocation ETFs, right? So these companies, they're the iShares, Vanguard, Horizon, all the big banks. They offer the all-in-one complete packages. So they're going to have the Canadian bonds, US bonds, stocks, the bonds, whether Canada or international, put them all together for you in one complete package, and everything is done for you. It's managed, rebalanced. There's nothing for you to do, but just add monies on a regular schedule. Once again, of course, now you could also build your own ETF portfolio that will have those assets. But again, you can see from the list here, you may add, again, those real estate, you may add emerging markets, you maybe go on beyond Canadian bonds, and go US and international. There's commodities. Readers of my site will know that I'm a fan of that for certain conditions, whether it be gold, energy materials, and specialized assets or sectors that you can add on. But once again, you don't have to do this. You may keep your portfolio absolutely completely simple to those 4 building blocks. And when you're in the accumulation stage, again, you might go that route, right? It's really more when we get into retirement or near the retirement, in the retirement risk zone, we might start adding more of those different assets to manage the risk. Because the risks, again, we'll do a zoom on retirement. They become much different in accumulation. Accumulation is dead simple. We're going to invest within our risk tolerance level. We're going to add monies on a regular schedule and make sure that we can simply get out of our own way. And once again, so here's an example of a balanced growth model. So again, it's going to have those 4 buckets. And really, there's no magic to it. You can change these slightly based on your research, but you could slice this in 4 equal components, if you like, 25% each in Canadian, US, international stocks, and the bonds. Rebalancing is a very important part too, right? So we're going to try and keep that allocation back to that, for example, 25, 25, 25, 25. And you may do that move just based on if one slips out by 5 or 10%, you're going to sell the winners and you're going to move it to the losing side, if you will, whether it be the stock or the bond component. But the major part there really is going to be, taking the stock winners and moving it back to the bond component, right? And again, a lot of the portfolios will just do it every 6 months or 1 year as well. And just put that in your calendar and do it. That works as well, because usually there's enough movement within that kind of period. Now, on my site, Cut the Crap Investing, you will find ETF model portfolios. There's examples in there. And feel free to have a look at those. It's not advice, of course. It's just models following sort of what is accepted kind of asset allocations, if you will. But I have my own biases. You'll have your own. I apply them in the portfolios there. So let's work it as a guideline, if you will. And how we're going to do and buy these ETFs, again, they trade like stocks, right? So and where we can buy stocks and buy ETFs is at a discount brokerage. All the major banks, you'll have one. So if you have a bank account, of course, you can check in with them and say, I'm interested in your discount brokerage account. There, you'll be able to buy stocks, buy ETFs. Other popular places, of course, are Questrade, Qtrade, and Wealthsimple. Wealthsimple is great. It's wonderful. You can open up in about half an hour, but it's a trading app. It's a little different than a full discount brokerage. You won't get a lot of features such as research and such, but it is a wonderful place to be. I'm at TD. I also have accounts at Questrade and Wealthsimple. So how do you buy? So here's an example using a screen capture from my TD discount brokerage. So here's how easy it is. You could take that balanced growth model, enter the symbol there, which is XGRO. That is iShares version of a balanced growth portfolio model. Enter the number of units you want there, 100, press buy, and presto. I mean, you have a globally diversified portfolio at your risk level of choice, all by just entering one ticker symbol. Absolutely incredible way to go at it. Now, again, very important to understand the trading process, if you will. It's not complicated, but make sure, check in with your discount brokerage or me, check out on my site, send me a note. Do your research. Just make sure you understand the mechanics of actually placing your trades. Okay, there's a couple of important things there. We want to make sure that we get the best price, right? And here, again, very important as well that, do the research to understand and cover the investment basics. I can tell you it is absolutely worth it to take that on. When I talk about and came up with the name of Cut the Crap Investing for the site, cut the crap really means is leaving behind those, terribly performing high fee funds that often come with no advice, sometimes poor advice. And again, I am a fan of wonderful advice and financial planning if you can find it. But for the self-directed investor, again, we can invest on our own. And if we do need that financial plan, and most will, you'll know you can get what's called a fee for service or advice only planner. So you're not going to give them money out of your pocket every trading day. You can just pay a la carte, whether it be, by hour or pay once a year for that financial plan. That's very important. And then you can move on to either build your own ETF portfolio or get one of those asset allocation portfolios. You might go to Tangerine. Even then, and again, if you want to manage portfolio and some advice, you might even consider one of the robo-advisors. That is a wonderful place to learn what's going on. And from there, what it really means, and would say on that front too, saw a financial planner advice only put a wonderful thing on Twitter just saying, like, every dollar that you pay to an advisor is a dollar that you're not going to invest, right? So that is a wonderful way to look at it. Yes, advice is important. The financial plan is important, but we can access that separately. And then we can go invest for ourselves. And the final destination, really, it's just a quicker route to the final destination, whether it be retirement or, again, whatever is your form of financial freedom, right? And without, we see the Questrade ads that say retire 30% richer. It's way more than that. I mean, I did portfolio reviews for Tangerine clients for quite a while. It was part of my duties there. And even just comparing to the Tangerine models, which are 1% area, it was no comparison. You really, truly can invest and make double, triple the money by keeping the money in your pocket. You'll know if you go to the Beat the Bank, Larry Bates site, he has a fee calculator. Once again, I'll put that in a post that'll have all kinds of assets that we can look at. But yeah, it's really, really that simple. And that is that.
Awesome. Thanks, Dale. Just going to remove the pin there for you. So why don't we have, again, about half an hour here together. So why don't we use the chat here, and if you have any questions that you want to ask Dale, put in your questions and make sure you don't direct message me. So some people are direct messaging me. If you want it for the general group, just make sure you select everyone in meeting versus sending it to me. So Yeah.
Oh, okay.
So
How do I get my full screen back, Brant?
yeah. So in the upper right, if you want to stop sharing,
Right.
or I can boot you out of there if you want me to.
Sure. Yeah, maybe. Yeah.
Okay, hold on a second. Let me
If
do
the
that.
rest of my screen comes up.
Okay. Okay. There we go.
Okay, cool.
Yeah. Yeah. So we've got a few questions coming up, and the other option too, if you want to verbally ask your question, just raise your
Yeah,
hand.
that's fine. Yeah, chat's good. Open chat.
So why don't we just start looking at some of the chat ones? So someone said here, Glenn asked, since 2020, Dale was successful in early calls for investments in energy, XAG,
Yeah.
banks, ZEB, and commodities, PRA. What area of the market is currently at lows and worth allocating money to?
Again, that's, playing around the edges and stuff. I still like, I mean, there was news today that I think Synovus had pretty good results, and they actually have some hedging in place. They're going to triple their dividend. So again, I really like that space. But again, the commodities and such is just an add-on, right? We see the material stocks, commodities, energy. They're benefiting from the rising environment of commodities exposure or commodity prices going up. So because they're priced, or they gain from that, whether it be an oil price or silver price, gold, whatever it may be, potash, they're benefiting. So I still like that area as add-ons. And I think too, even looking at, maybe the tech in the US is going to start to look pretty attractive, right? I've been waiting. Again, we talk about portfolio rebalancing. I was selling some of that over the last year or so, in my wife's account, where she holds more of the growthy tech stuff. But that might be time to move some of that back, right? But again, in talking about the main thrust here today, though, is we can't ignore all that stuff, because that's in a lot of that stuff's in the core portfolios, right? When we buy the market, we see the Canadian stocks have been doing well. There's lots of energy in there now. There's gold. There's lots of commodity stuff that's elevating. That's why the Canadian market is doing really, really well compared to US and international. It has been one of the best performing stock markets. I like to add a little bit around the edges as well for commodity, sort of for inflation protection. But again, once again, in the accumulation stage, don't have to worry about that. You can just buy the markets. The consideration there might be, again, you might buy more growth-oriented assets than just the stock markets, which would mean a growth-oriented ETF, such as the NASDAQ 100, which holds all those big growth tech.
Okay, awesome. Steve asked, Dale, can you explain your all-weather portfolio?
All-weather. Okay, so here we go again. This is really, again, it's playing around the fringes, not necessarily important for those in the accumulation stage, right? Let's say you got 10, 15, 20, 30 years to go. But the all-weather portfolio, very important. And we're finding out how important it is now. And it was kind of a fluke, actually, because when I redid the couch potato models for Money Sense, and they were just typically core before, right? Just the stuff I gave you today. But I also put the all-weather models in there, saying, because, for retirement and such, or even just greater risk management, what it's going to do is it's going to include commodities and such for inflation, right? So it's not well known that stock markets don't work for inflation. No, they typically deliver positive returns, because a lot of the companies will pass on those higher prices, right? But when you actually look at returns that are above the rate of inflation, they typically don't. Not even the Canadian markets, and especially in stagflation, Canadian markets did not deliver, as close, but they did not deliver above. So for me, the idea of an all-weather portfolio, again, is we have conditions of growth, economic growth, non-economic growth or decline. We have inflation and deflation, and we can get mixes of all those. An all-weather portfolio is going to have something that works in that bucket, that quadrant, and that quadrant. So the idea is that something's always working. The thing is, though, is when you add the all-weather and you go to commodities, inflation protection, that usually stinks the joint out, right? Like, I was just kind of lucky that I threw these in, knowing, because commodities can do terrible for like 10 years, 15 years, 20 years, because they don't work. They're negative. They don't work in a disinflationary environment. And from 1981, that's all we've been in, other than little tiny bursts of inflation, right? So it's just a fluke that I do that, and all of a sudden this inflation spike comes along and the threats of stagflation. But typically in accumulation, that's probably not a place you want to go. For my money, I think it's more useful when you're If you just want a lower risk portfolio, certainly do it. But again, keep in mind when you have all these assets, they're, think of bonds as shock absorbers. Those shock absorbers are heavy. They're going to be a weight on the car, right? We know as we put in more bonds, lots of bonds, we're typically going to reduce our returns. The same thing can happen with all weather. But that said, if we want a more balanced mix moving forward, we might have all weather will typically be lower volatility, less, we're really getting into kiddie coast there, but you might have to give up some returns. And does that help, or anyone need more
Yeah, feel free to unmute if you want.
clarification on that as well? Or
Steve's question, yeah.
I'm all weather. And again, our portfolios we're making up until just a few days ago, we're continually making, new highs. It's just the last week or so when everything started to stink the joint out that it's not, but still hanging in there pretty good.
Good.
I have a question. Can I ask just a quick question?
Go for it, Dave.
So let's say you're in the accumulation phase and you're basically about a 60-40, close to a 60-40. And then you're looking to try to, combat the high inflation a bit. When on that all weather, what do you think is a good percent add-on of commodity ETFs? Like, for example, XEG, XBM, and COW, for example.
Great question. I would say, if in the area of like 10% or more, even 15, I'll put this post in, I'll do a blog post that has all the resources that can react to this questions and presentation. But I did what we call it was a inflation bolt-on. So let's say if you had a asset allocation portfolio, you're running your own 60-40 day like that, you can just bolt them on, right? So again, I did an example where, and kind of close to what I'm doing too, I was like 10% PRA, from Purpose, right? They have that real asset, which has gold, commodities, but it's got stocks in there too, right? Like it's gold stocks, energy stocks, it's got the whole basket. But I've done that, and I've added on, I'm about 5, 6, 7, 8% in certain accounts of energy as well. So I'd say about 10 to 15%. And the good thing about commodities is, again, they're the only thing that works reliably for inflation, right? If you want to be, and gold is a wonderful asset too. It takes a lot of heat, but the thing is, they're so explosive that they can deliver in times about 8 times the returns of inflation, right? Go back and look at a chart for stagflation. Look at gold, right? Look at commodities, just exploded. Gold went up about 9 times, right? It was just absolutely incredible. So because of that, again, you don't need to use as much of them, right? So keep in mind that the more I kind of look at markets and evaluate markets, I know we're not supposed to market time and such, but since I started writing for Money Sense, either I got lucky or it looks like this stuff doesn't happen in the dark, right? Everything's announced what's going on. I think you can make some calls on, on asset allocation here and there, not going crazy, but they do kind of announce themselves, and inflation did too, right? On Money Sense, I was, it was the beginning of 2021, and even before it, saying this stuff looks inflationary. I was just repeating, from smart people. I think that's the key in the investment world, is find who's smart, who to follow, find some consensus, back up the data if you can. It was obvious that it was building, right? And then it was obvious that it wasn't going away. That said, if you look at a chart of stagflation in the 70s, and I looked at the other day, I go, can I be smart enough to try and time this and send some hints out there? But no, you got spikes of inflation, going down, goes away. Oh, another one. It's like, I don't think you'd be able to time that. Again, not living in the 70s investor, don't know if the signals were there. Right. But I think mostly if you want to protect from inflation, you keep a core. And then now we see it still heating up. So it's happening in plain sight for it. So again, I think 10 to 15. And it comes down to personal preference from there.
So maybe just a follow-up question on that then. So if you're adding the 10 or 15, then what are you substituting?
Great question. I would trim from everywhere, but you might slant a little bit more to the taking away from the bond side, right? So a little bit from everywhere, if that makes sense. But because I think of the bonds as the risk manager, right? Those are your risk managers, and your other assets, your commodities and such, are also your risk managers. That said, keep in mind, when we want to protect for deflation and stuff like that, or recessions, that's where the bonds come in play, right? So we do have to be careful. And we don't want to take ourselves out of our risk tolerance level. Keep in mind though, in this presentation where I threw up that slide of the balanced growth portfolio, that is kind of the sweet spot for returns, right? That you don't, over many periods, you don't give up anything. We always think of the all stock, more is better. But because of corrections, those corrections in the bonds, they become equalizers, right? And there are a lot of longer periods where that balanced growth model will keep pace with the stocks, because stocks will get ahead, and then we get a correction and the bond portfolio will come up, so the balanced growth, and they kind of meet again. They kind of cross in waves and eat out of each other. That said, I would say if you're an accumulator and you have a high risk tolerance level, just go stocks, go growth, add on that growth model. Again, I use a combination of ETFs and individual stocks, and my little tech basket, it doubles the market returns, and it actually even generates about 2 to 3% more than the growth indices. So happy to hold those. And again, when the price is right, I'll go back for more.
Thanks, Dale. All right. Thank you. Good, David.
Thank you.
Yeah, thanks, David. Great questions. I'm gonna Adulis has his hand raised, or I just want to go ahead, Adulis. What's your question?
Hey, Dale, thank you for your time. I appreciate it. So I just, I've been awakened, baptized. I had a mutual fund, and now I'm self-directed. And, subscribing to your email newsletter definitely helped me awaken to that. And so, and I just want to set it and forget it. I don't, all of this talk of deflation, inflation, commodities, do this, do that. Can I just buy an iShares growth ETF portfolio? I'm thinking of XGROW 80% assets, 20. Can I just buy that and I'll be good? Or do I have to do other stuff as well too?
Absolutely.
Okay.
And I really like the iShares models. I like the Horizons. The TD one-click are wonderful. I mean, they're all quite close, but the asset allocation is a little bit different. And even have a look. I mean, I think the Horizons model, it just for my money, is superior in that what it does is has a bit of a barbell. So it does include, we talked about the NASDAQ QQQ, which is a very growth-oriented index. It adds that in, but it also puts in long-term treasuries, which are the most kind of dangerous kind of bonds that will, get hit the worst in price when it's bad, but go up. So what's going to happen soon, I think, is that the long-term treasuries are going to start to go up eventually if we do get that recession, and they're going to move that money to the QQQ. That said, I love iShares, and yeah, Adulis, you can just keep plowing the money in, whether
okay. So if it's inflation, deflation, the Bank of Canada is raising the interest, it doesn't matter. I could just keep buying this and I'm okay.
Right. So here's the thing, right? And could have made this clarification for you guys. The stocks are wonderful, wonderful inflation. Let's call it a hedge, if you will, over longer periods, whether it be 20, 30, 40 years, right? Once again, it's just because it's so growth oriented. And to be honest, mostly because we're not in a high inflationary environment for most of the time, right? So historically stocks will take care of the inflation because, again, there's just so much growth. So you typically don't have to worry about that when you're in accumulation. Would say, for me, I would suggest that we enter what's called the retirement risk zone when we are within about 10 years of retirement. Some would say more, even 5, because even at 5 years before retirement, you can start directing all of your new monies that you might have been investing and all your portfolio income that you might have. You could start moving that to more of the bonds and gold and commodities, if you like, to create more of the risk managers. So whether it be 5 years, 10 years, that's really only what we want to start preparing for, and need to, again, do that shift from accumulation to decumulation. And of course, decumulation will be the word that we use for retirement funding. So yeah, but as you're in accumulation, just keep going at it.
Okay, and my final question is, because my bank took such a long time to transfer from my mutual funds to self-directed, and I'm not sure if they're being 100% honest about me regarding. So I'm employed, so I contribute 12% to my RRSPs, and my employer matches that with 6%. And so the money that my employer matches, it's in a deferred profit sharing plan, DPSP, and my bank keeps telling me that the DPSP can only be mutual funds. I can't. I'm with RBC, so they're telling me it has to be managed. It can't be self-directed. I can't do it on my own or whatever. And I'm not sure if they're being 100% honest with
Yeah,
me about this.
that may be, maybe it might have to stay with your employer. That may be what they're saying, right? And they
No,
only,
no, yeah, I'm fine with it staying with my employer, but they're telling me you're in a walled garden, meaning
so they don't,
mutual funds are the only game in town. That's what they're saying.
for them, yeah,
Yeah.
most companies don't set up, they could go with a robo advisor, and where they have services where you can actually have your group plan, if you will, but most of them just have mutual funds, and most of them not very good. I have to say that's kind of my first experience becoming on the ETF side is I had to go with, we're saving for our house when I was at an advertising agency. And all they had there was investors group, and it was terrible. The guy was telling me to put it all in Japan. And it was saving for a house. Like, it was terrible. But that's all they had, right? Even now, fortunately, like my neighbor here, he has a wonderful group plan where I looked at it for him, and there were mutual funds, and there was all kinds of ETFs, right? Or index-based funds, the same kind of idea. And so we just put together a real simple index portfolio for him. Not all employers offer that, unfortunately. Anybody listening in and watching, you could go if your employer doesn't have good stuff, push them on it and say, like, maybe you should look for something a little better. One option, you can go to like a Just Wealth and Nest Wealth. They can change and find a better way at it.
Great, thanks.
Yeah, thank you guys.
Yeah,
thank you.
Awesome.
Thanks. Good question.
Lots of great questions here. So I know we're not going to get them all of them in 15 minutes. So let me just look at it. So I'll just go to the last one asked, actually. Where's the best place to find a fee for advice advisor?
Send me a note. There's lots of different options. I mean, even in my last Sunday post, right, there was Jonathan Chevreau post. She had a post on his site and did some look at her offering, and she does coaching. Have a look at your portfolio existing thing. Really decent prices of like $300, $400, $500. If you go to a financial advisor like Money Coaches Canada, they can be quite reasonable too, right? Where you can get pay $800, $1,000, $1,200. But typically, if you're going to start to get into the full plan, it can get into $3,000, $3,500, $4,000. So if you look on my site, I do offer up some options and kind of an overview on, if you even just Google, what is an advice only planner, or click that in on my site in the search. I have some info on that. Send me a note too. I'm happy to. Again, it's not advice. I can't say that I know for sure the background on everybody, but I do, speak with the advisors out there, and I get them to go, not to rat on each other, but the opposite. I go, who do you like? Like, who do you know does besides yourself? Who does really well? And I'm starting to get a bit of a consensus, right? So, and there's no guarantee, but again, you really want to match the life stage too, right? Where that, if you're in a retirement stage, you want to make sure you have a retirement expert, right? And again, Alexandra McQueen has done a few posts on my site. She is wonderful. Just in conversations with her, I really trust her knowledge. And even that, she's one of the only ones that will, even look at things outside of the typical stock and bonds, and look at annuities or some of the annuity ETF products that are out there too, right? That Purpose had that one. She really understands that side, and most of us won't go that route, but annuities are super bonds and they don't get into the conversation. But the researchers that I trust and follow, like the Kitzes and Wade Fowle and stuff, they'll say, no, all the models show, why not give them a go? Not when you're maybe 60 or 65, when you start getting to 70, 75. And even, that Purpose retirement income fund, I forget the name of the actual product, but it's kind of like a pension fund for the rest of us, right? It's a really good product. And you might, again, when the time is right, add a little slice in there, because like a pension, it has that survivorship benefit at the end. As the unfortunate die, there's a survivor benefit, all gets moved, and it really boosts up the income at the end of retirement. So again, feel free to send me a note, and I can give you some guidance on it.
Jump to some more questions here. Yeah. See if you can this is like the fastest.
Okay, I'll go quicker, like lightning round, like Jim, like Kramer.
Yeah, exactly. So Karen asked, in the decumulation phase with no debt, own our home, still have self-employment. So how important is an emergency fund? Should we continue to DCA instead until no more self-employment?
Right. I think, I mean, everybody knows their own costs, if you will, right? The risks of what could go wrong for the number of properties they hold type of house. No different with a new house, old house, right? So we all have a bit of an idea. I think you kind of need to still have a cash emergency fund. That said, feel free to roll the dice, right? Like in a lower risk portfolio. I'll admit to kind of going over time where I had a cash component, at the same time built up a tax-free investment portfolio, was comfortable enough within that in the balance model that I started to use that as the emergency fund. And keep in mind too, that if you have a line of credit, right, you could access that line of credit to get you over the hump, if you will, the HELOC, if you will, or other line of credit, and use that in combination with the portfolio.
Okay, awesome. Tracy asks here, I'm just starting to invest late to the game, so I'm not sure how late, but what are some good things to pick up in the current environment? Probably feeds back to what you've already shared.
I think just start and find out or know what is your risk tolerance level, and just keep adding money on a regular schedule. And if you're late, you know what? No worries. I did a post for Tangerine, and I believe I put it on my site too, which is, you know, how to play retirement catch up. Like you really can, if you say, oh, I didn't start till I'm like 40, 45, 50. But I mean, we can only do what we can do, but you can go gangbusters at that if you have good free cash flow. Free up as much. It's really surprising how much you can catch up. Catch up. We all know, of course, that, you know, starting earlier makes it a lot easier. You can invest smaller amounts, but you can play. The key is just get going at it. And again, you can use, here's the thing too, when you're playing catch up, you can find in articles, you might have a lot of RSP room where you can make a major contribution, get a tax return, either pile that back into your RSP or your tax-free account, right? The key is to use that tax return and know your mix of RSP to tax-free.
Got it. Okay, thanks. Sounds good. Dawn's asking, can you explain the fees for the all-in-one ETFs?
Absolutely. So they're in the area of, again, 0.2, so 0.20% to 0.25. Once again, you know, that's 1/5 of 1%. It's really a 90% off sale from typical mutual funds, right? And again, there's no doubling up to say, oh, but it holds this ETF and that ETF. They take that into consideration. It's a total fee. And once again, you can buy those for free. There's no, if you're at a Q Trade or a Quest Trade, you can purchase ETFs for free. You know, when you rebalance, they'll typically charge a bit on the sale. But again, the fees are absolutely incredibly low. And again, that's the part that really can make it life-changing, is when you cut your fees by 90%.
Right. Andrew's asking the pros and cons of U.S. investing. Not getting the Canadian dividend tax credit. So.
Yeah, sorry, that question was in there too, the dividend tax credit, or?
You're saying, and not getting, what are the pros and cons of U.S. I guess you're not getting the Canadian dividend tax credit if you're doing.
Well, what can happen again? Investing in U.S. stocks is crucial, right? It fills in the holes of the Canadian market. Canadian market, again, we're financials and energy and commodities. Not much else. There's no healthcare, right? Our healthcare is pot stocks. Like that's actually, you go to the health index, it's pot, right? It's all that kind of stuff. So. Again, not a lot of growth as well, not a lot of tech. It's getting better though. So it's going to fill in all those holes from a lot of consumer staples, consumer discretionary, tech, again, healthcare, just all the stuff that we're missing. So it's very important. And again, keep in mind that some will worry about, you know, losing the dividends, but if you're in your RSP account and you use a US listed ETF or just buy the stocks in a US account, you will not lose the dividend part, right? There's some withholding taxes, very minor, not necessarily something we want to worry about if the market's not really paying much by way of dividend anyway. Right. But US stocks are crucial. Some will argue that you can get away with Canada and US because these are global stocks, right? Even, you know, when you talk about the Microsofts, the Apples, the Johnson Johnsons, the Walmarts, even Abbott, which it's a European one, if you will. A lot of these companies are global, and you get that exposure. Where you really want to look at too, again, is emerging markets, because that's where they keep the favorable demographics. So I'm a fan of that, is looking at that as well. US is key.
Great. Do you want to just remind people of our disclaimer that I don't think you mentioned it from the beginning.
Just
the lawyer in the other rooms remind
everything is certainly here is for informational purposes, as we say. Again, on Seeking Alpha, I love their tag, which is read, decide, invest. So again, make sure, again, I always say on a lot of posts do, like if you don't know what you're doing, don't do it. For one, right? So if you're pressing the button going, I'm not sure really what I'm getting into, doesn't mean you have to understand everything, all the nuts and bolts, but if you understand that you're buying, the stock markets of the developed world, you're comfortable with that and know your risk tolerance level, go ahead. But again, informational purposes, and get your information from lots of sources.
Awesome.
Even I do, as much as I am an investment nut, I get my stuff from everywhere.
So we got a few more minutes for questions, and then I'm just going to ask a couple of questions in the chat.
Yep.
Or already comment, and they're wishing this is a weekly event. So we'll ask. Well, that's one of the questions. What else do you want? And we'll get to that in a second here. So it looks like probably we'll take 5 minutes at most for a few more questions here. And so let's see here. Suzanne is asking, I'm close to retirement and I'm about to DIY invest for the first time. I'm thinking of putting a chunk of my RSP into a short-term GIC at EQ Bank, right? Buying a low volatility ETF with the rest. The MER is high on these, but I need money within 5 years. That's a lot there to absorb. What are your thoughts on that strategy?
Right. So it was a GIC and then a low volatility. Yeah, you know what? Here's the thing too. Low volatility portfolio. Of course, BMO has a wonderful one, right, that I have penned about quite a bit. That is a great way to go at it actually for retirement, because it's looking for lower volatility stocks. And so again, I have less drawdown, right, by design. And actually, there was one of the big banks put out an article recently saying the current environment that we're in right now favors low volatility, because if you look at the sectors that are in there, they're more defensive, right? You get like utilities, healthcare. So yeah, but really what you're doing with the GIC is you're managing the short-term risk, if you will. So you've got that bucket to draw from, that is the safety bucket, if you will, and you've got stocks. So that's a good combination as well. I like that. And I think within the BMO low vols and stuff, as an example, there's some REITs in there as well, which again can provide some inflation protection in certain conditions. Once again, just a personal thing, my idea would still to bolt on a little bit of inflation protection, whether it be PRA or other, because just think if we do, and nobody knows, what if we do get into a stagflation environment, right? That's when not much works. And I think we'll be glad that we have the energy stocks, the gold, the silver, the other commodities. So just a personal take, keep in mind that, that the stocks and stock markets won't necessarily provide a great hedge. Doesn't mean they deliver zero or nothing. But it's just nice to have a little bolt on. That's just my take. I like probably because it's working so well right now too. Probably a recency bias, right?
Right. All right, let's see here. Let's do 2 more questions. So I think it's Anurag says, are there any websites which can prepare the financial plans? Advisors state that they have cool software that you can do the math for you. Can DIY investors pay for such applications or tools to have access to, I guess, to maybe those algorithms?
Absolutely.
Whatever
so there is, it's going to escape me for a second, but it's on my site. Oh, it's called Cascades. So you could go to a place called Cascades and you could run your own models, right? Not sure of the cost. I know it's quite reasonable, actually. But you're right. It's the same kind of stuff. Now, financial plan includes a lot more, right? All the holistic stuff, if you will. But the core nuts and bolts are like, should I take from my RSP, my tax-free, pulling from pensions? What is the right order and mix, which will ebb and flow? And you get some nice charts and graphs that provide that. So you could do that Cascades. Again, another sort of partnership for my site, as well as everybody on my site knows, Mark Seed from my own advisor. So he teamed up with another friend, Joe, I've chatted with a few times, and they run cash flows and portfolios. So they will do that for you. So you don't have to pay the full financial planner fee, if you will. And they'll run those tables for you, give you a little bit more. And yeah, so again, everybody, I think we need to do, again, we don't want to pay for advice that we don't need, right? So it's simple for many people, and know what you need. And now that said, sometimes you don't know what you don't know, so you don't know what you don't need. In retirement, I think it's, as we approach, it's a good idea for most to go to a financial planner of some sort, get a second opinion. But if it's really, like I'm chatting with a reader recently, just has a couple buckets, has a good pension, got a small, like a decent RSP, decent tax-free, just needs to know the proper order of harvesting. Mm-hmm. Go to Cascades if you're comfortable running it, or go to cash flows.
Great. Thanks, Dale. That's awesome. I'm going to finish with Wally's question since I can see Wally's face here. I'm like,
Yeah, I'll try and be quick.
I feel like we owe it to him to answer his question here today. So why is TD and BNS down? Is this a buying opportunity to dollar cost average?
Yeah, I guess the banks are down. Over time they should go up if we do get the rising rate environment, right? And we get that nice spread between longer borrowing costs and shorter, they profit from that. But I think the markets now are not buying, they're not buying much. They're thinking, as they turn, they're kind of thinking recession and stuff, right? Again, I have no idea what's going to happen. It's just the markets are silly and crazy and they react daily. I've never seen so many swirling risks these days that are in these days, right? Because there's just risk from everywhere. So the market seems to change its mind all the time. I think it's not convinced that we're going to move into that rising rate environment. We just try and tame inflation, that they're thinking things could get nasty. Here's the thing, banks are wonderful investments. I'd add to them if you like them. Lower prices are good.
Yeah. Okay. And again, Dale's, we're going to do more of these calls. So if you don't get all your... So I'm just going to put two questions in the chat. So here's just a big open-ended one. What would you like Dale to cover in a future call? If there's anything that comes to you, again, there's a few questions we haven't answered, and we'll make sure either Dale will reach directly out to you or put it in the newsletter. We obviously have your emails that you provided when you're registered for the call. So what would you like Dale to cover in a future call? If you want to put anything down for that, that would be, we'll just take 30 seconds for that one. Feel free to put that in. And then here's our last question for today, for you. Actually, I think we'll... Here's the question.
All great topics, yeah.
Yeah, there's some great topics there. So what's one thing you're taking from this call today? What's one thing you're taking? Could be an insight, could be a question, new question that it's raised for you. What's something, just give us a sense, it kind of gives us a bit of feedback. Like what's kind of grabbing your attention? Yeah, Karen, DIY's working for you, great.
Nice to see that.
Yeah, Dale's hair looks great, yeah. I'm jealous.
I might even get a cut for next time, who knows?
We'll have the Dale we'll have a...
I told Brent I have to keep it long to show my hippie friends at Wasaga Beach before I cut it out.
Clarity, I'm on the right track. Cost, fees matter, safety. Yeah, nice to see all the support. No, we're not alone. Awesome. Okay, Dale, do you want, so in terms of just closing the call, I think we had talked about doing a few more of these. So one on retirement for the other phase.
Absolutely. I think that's a key and obvious, right? Is retirement. Once again, it's nothing here can be advice. I'm not a licensed advisor, but I've certainly done my 10,000 hours on that area, and happy to share on that. I think building again, we can keep it simple with ETFs, but building the stock portfolio and again, the all-weather portfolio, right? Those are key things. And even they all start to meld together, right? Because we can use types of stocks, and that will be another one coming up is, right. In a low rate environment, how do we use types of stocks like utilities and telcos and pipelines? How do we use those as bond replacements that allow us to lower that bond exposure? Because bonds do kind of suck today. I still like them. Keep going at them if you like them. Like lower stock prices are good. Lower bond prices are good, right? Everything, we don't want to react. We don't want to be in paralysis. We want to just keep adding our money on a regular schedule. I still like bonds. I think they get more attractive every day, but we can use some substitutes. So that can be in the mix as well. And again, I saw some other good topics that came up there. Tax efficiency, all kinds of REITs. So yeah, really, we could go on and on and on, right? But I think we'd stick to the core areas, and it's been a great responsive. So I'm happy to certainly do a lot more of these.
Yeah. Thanks everyone for attending. It was our first one. This was an experiment for Dale and myself. So we just kind of talked about it last week. So it just shows you.
And again, I'd like to thank Brent here for putting this together. And he's really pushed me to get off my butt and do this and do something that hopefully is useful. So I appreciate the push from a lot of readers, Brent, in particular for doing this. And I think it's a great initiative. And I think we can take it even further. But thanks, Brent.
Yeah, my pleasure. It's great to help myself and help everyone else. So I learned a lot as well. So scratching my own itch.
Yeah.
I really appreciate it. So we'll definitely be in touch. Again, we'll have your emails, Dale. We'll send that out. Make sure you know of the next ones that are coming. And
yeah, and feel free to use the contact form on my site. Reach out with any questions we can get to. I'll as fast as I can. I'll try and get to them. And if not, it can maybe become a topic of a further Zoom.
Perfect. All right, let's call it there. Thanks, everyone.
Thanks, everyone.
Thank you.
Thank you.